Forget Wall Street fat cats. Vanguard puts you in control. Vanguard disrupts the investment landscape with a unique structure. Unlike publicly traded firms beholden to external shareholders, Vanguard's funds are owned by their investors, making them the true owners of the company. This translates to a significant advantage: lower fees. Vanguard's unwavering commitment to its investor base fosters a culture of cost-effectiveness, reflected in industry-leading average expense ratios, 0.09% compared to the industry standard of 0.50%. This innovative approach allows you to keep more of your hard-earned returns, empowering you to achieve your financial goals. As of 2024, Vanguard has $9.3 trillion in assets under management, making it second only to BlackRock, which boasts $10.5 trillion in AUM. Headquartered in Pennsylvania, Vanguard is the largest mutual funds issuer in the world and the second largest issuer of exchange-traded funds. Vanguard has 208 U.S. funds and 215 international funds available. The firm boasts more than 50 million investors. It also has one of the largest bond funds in the world, the Vanguard Total Bond Market Index Fund. Within the industry, Vanguard is a leader in offering passively managed mutual funds and ETFs. It is known for its stability, transparency, low costs, risk management. John C. Bogle began working for the Wellington Management Company in 1951. Through his years at the company, he held various positions before becoming an executive and eventually president. Following a dispute with a merged company in 1974, Bogle formed a new company called the Vanguard Group of Investment Companies. He named the new company Vanguard after a British ship because he admired the leadership theme it embodied. Bogle created the first index investment trust in 1976, now known as the Vanguard 500 Index Fund. Although the fund's growth was initially slow, it took off. By the 1980s, other mutual funds began copying his index investing style. Bogle created Vanguard and molded it into a place where retail and individual investors could turn to build wealth without needing the services of a broker and the expenses charged by them. His vision was low-cost investing and transparency for non-institutional investors. Vanguard now has some of the largest index funds in the business. It offers funds aimed at achieving a variety of investment goals, including retirement savings, dividends, value investing. Like any other investment strategy, investing in index funds comes with both pros and cons. All investing involves risk. Knowing what risks are associated with index funds can help you decide if they are the right investment choice for you. Lower fees, easy for new investors, less expensive. Diversity, beat actively managed funds. Limited returns, lack of reactive ability, risk for short-term investors, limits personal strategies. Index funds can charge lower fees because, with few exceptions, they track an index that is only changed if a stock listed on the index no longer meets the criteria for being listed. This means index funds are passively managed and don't need as much attention as those that don't track indexes. New investors with limited capital, knowledge, and time benefit from index funds because there is no need to analyze stocks to find ones that suit them. Stocks on indexes have already gone through rigorous evaluation and weighting. Investors can easily read through the prospectus and reports and find funds that fit their interests and goals. Index investing is less expensive than many other investment options. Apart from fees, index funds have much less turnover than actively managed funds. This keeps the investors from having several taxable events and racking up capital gains without cashing in their stocks. These funds can provide diversity that funds full of hand-picked stocks may not. Index funds let you hold stocks from hundreds of companies rather than focusing on a few from one industry or company. passively managed funds beat those that are actively managed because of the associated fees and additional costs. Short-term returns may not always be higher with index funds, but active fund managers fail to beat benchmark indexes most of the time. For example, just over half of active funds underperform the S&P 500 over a one-year period. That number jumps up to over 91% over 10 years. The returns for an index fund are limited to those of the underlying index because index funds attempt to mimic the returns of their benchmark. Because you're investing in a fund that mirrors an index, you cannot act on undervalued or overvalued stocks within the fund. Short-term investors are exposed to downside risk with index funds. Investors who don't invest in index funds for the long term might see decreased returns or even losses. Most index funds are best for long-term buy and hold strategies. Index fund investing tends to limit the investment strategies you're exposed to. Your strategies are limited to that of the fund and index managers unless you have included the index fund as part of your overall strategy. According to the Vanguard Group, the company is owned by its member funds, which are owned by the fund shareholders. Thus, the fund shareholders are the owners of Vanguard. Vanguard is owned by its member funds, which are owned by fund shareholders. Therefore, someone who has purchased shares of a Vanguard fund is a Vanguard owner. Vanguard does not have outside shareholders. Vanguard's owners are its fund's shareholders. If a fund holds shares of a company, then that fund and the fund's shareholders are owners of the company whose share is held. So, Vanguard doesn't own any companies. The fund's shareholders do.